Ladies and gentlemen, welcome to the Fintech Frenzy Daily Show. Today is September 11th, and in fact, we are going to be going over SoFi Technologies' analyst report from Morningstar, giving them, and I'm going to give you a spoiler, a fair share price of $14.50. Okay? Next, we're going to go on to Nubank, talking about their upgrade, the price that they got, and the reasonings for their upgrade as well. But first, let's talk about SoFi. We're going to begin here. This is the full report, okay? So I've highlighted all the things I've wanted to highlight. We're going to go through it. Let's first start off with everything that we could see here. So at the time that this report was actually made on August 16th, we saw a price target of $8.26 just a couple days ago. That was the exact same price as SoFi. It's run up recently. I think it's about $8.80 something cents at the time of recording this video. But then at fair value estimates, they're saying that they think that this stock is better priced at around $14.50, making SoFi's price to fair value assessment at 0.57. That gives the stock a market cap of $7.95 billion at the time that they recorded this, or at the time that they reported this. And then economic moat, they're saying, what's the moat for SoFi? None. There's a high uncertainty of this not happening, and the allocation for the company has been just standard. So let's go through and cover what they had said. So first off, this is the analyst note. This is from Michael Miller. They said, we're increasing our fair value estimate to $14.50 from $14. Roughly half of this increase reflects the time value of money since our last update, while the remainder is due to the lower near-term expense growth projections, as we now expect SoFi to be profitable during 2024. Okay, what else do they say here? They said, we expect SoFi's student loan originations to improve, although higher rates means that they're unlikely to return to 2019 levels anytime soon. So they are actually baking in that this is not just going to be a student loan, return sort of situation where it's just going to be, the massive improvements just from that one business line coming back. They are saying it is going to be unlikely that they're going to be returning back anytime soon, which is good news, honestly. If they're being more pessimistic and still giving it a $14.50 price target, then I'm quite excited. So they talk about SoFi's business strategy and outlook. They said, unlike existing digital banks, which generally have limited product offerings, SoFi offers a full suite of financial services and products, including everything from student loans to estate planning. The intent is that they will allow its customers to structure the entirety of their finances around SoFi. To meet this goal, SoFi has used a mix of internal developments and external partnerships to rapidly expand its services. They actually go on to talk about how this is actually a negative part too, how they're doing a bunch of external partnerships because it's not really, creating a moat for them, but still, let's go on. But SoFi's largest segment still is lending, provided more than 70% of its revenue in full year 2022. So a couple of the things that they say are massive bull cases, or what the bulls say, right? SoFi has rapidly launched an impressive array of products and services and remains the only firm offering a full digital service model. SoFi has enjoyed surprising success in building its deposit base with its new bank charter, reaching well over $12 billion in less than 2 years. The Galileo acquisition was likely a major win, as the number of accounts on its platform has risen since acquisition. What do the bears say? Revenue growth has come at the cost of rapid growth in expenses. SoFi remains unprofitable. SoFi's near-term results will be affected by uncertainty surrounding the politics of student lending. And then many of SoFi's products and services are the results of partnerships which are easy to replicate, creating the risk of future competition. So let's quickly take a look at the competition here. As you can see, SoFi, fair value, $14.50. At the time that they recorded this, is an $8.26. They think it's a 5-star price target, anything under $8.70. Comparatively to Discover Financial, Ally Financial, and Synchrony Bank, they all think that these companies are undervalued, but comparatively, This is the price to fair value where they're saying what's the multiple versus these stocks where they should be. Comparatively, Discover comes next, then Ally, then Synchrony Bank in terms of price to their fair value, where SoFi is coming in at by far the lowest, giving it still a 5-star Morningstar rating from Michael Miller. Now, it is the same analyst across the board. The price to fair value is the lowest. 5-star rating, anything under $8.70 is what they consider 5 stars. I guess maybe I'm being a little choosy whenever I want to buy in the $7 ranges. But still, whenever you put it up against other companies that could be purchasable, it is quite interesting. Another one that I wanted to show off is that economic moat. They do actually show Discover Financial having a narrow moat. Obviously, this is because they have their own schemes for payments, but economic moat. So what they said, in our view, SoFi has identified an unfulfilled product need in the market that will allow it to build a defensible competitive advantage. However, they go on to say, it could create powerful cross-selling advantages that will reduce its cost of acquisition, making existing relationships stickier through, implicit switching costs. While it was making good progress towards these goals, it is simply too early to assume SoFi will be successful in building a competitive advantage. While we are encouraged by the momentum seen in recent results, the company has not made enough progress for us to see significant confidence that will be earning returns above its cost of capital 10 years from now. Thus, we assign SoFi a no moat rating. While we do expect the number of multi-product clients to increase, this process will take time and likely further reward and incentive spending. Once SoFi can build a multi-pronged relationship with customers, we expect customers to face implicit switching costs, which will make it harder for them to leave. But until SoFi can do that, there is little to hold customers to the firm beyond price and reward spending. Additionally, the speed at which SoFi has been able to create new products and services for its customers cuts both ways. The company has been able to accelerate development by strategically partnering with other providers and banks. Its brokerage accounts, insurance, estate and financial planning, auto loans, and cash management accounts are all offered through partnerships. Cash management accounts, not so much. There's nothing to prevent another firm from taking similar paths, creating the potential for new competitors to enter the market in short order. For SoFi to build a competitive moat, it will need to use its first mover advantage to establish a more profitable member base before anyone has a chance to replicate its product suite. This creates a greater deal of uncertainty for SoFi's chances of building a moat, as the company has demonstrated handily that the product it offers can be brought to market quickly. Quite interesting take, honestly. I thought this was really well balanced whenever reading this. They go on to talk about how refinancing is the big part of their business, but how this is sort of cuts both ways as well. A loan that has been outstanding for some time is less likely to default than the one that is newly originated, and is proven credit, reducing the need for high-quality underwriting. This also removes barrier to entry for small firms with disruptive business models like SoFi. This space is highly competitive, with the interest rates being offered to debt holders being the primary form of competition. As a result of a lack of clear, durable competitive advantage presented in SoFi's existing business, we give the company a no moat rating once again. Now, in terms of fair value and profit drivers, they still, even with what they're considering no moat, a fair value of $14.50. Our model assumes that student loan forbearances ends in 2023 as planned. We also project personal loan origination volume growth to slow from the breakneck speeds of 2022 and 2023. So they're not expecting, student loans and personal loans to be kicking off at the highest rates ever seen. They are expecting a little bit of a pullback, which means, their optimism is not sky high. Despite lower loan volume expectations, we expect that SoFi will continue to enjoy a high growth as it continues to benefit from accelerating customer and revenue growth drivers by expansion in its product lineup and customers' increasing comfort with digital banking. Absolutely. We project that revenue will increase at a 22.3% compounded annual growth rate over the next 5 years, as the company benefits from its unique product offering as well as its revenue contributed by its 2022 acquisition of Technisys. However, this growth comes at the cost of aggressive marketing and reward spending, and profitability has been elusive despite impressive revenue growth. Going on, they're talking about margin expansion, right? They said they're going to continue to get into selling and securitizing loans that they make for their customers. Instead, we expect SoFi will continue to use this extra source of funding to increase the delay between loan origination and its eventual sale, which means they can be a little bit more choosy, when they want to sell and when not to increase maximal profits. We do that right now with the bank charter. We expect SoFi will continue to use this strategy and its net interest margin to expand further as it replaces its high-cost external financing with customer deposits. Over time, we expect SoFi to benefit from cost advantages as it is able to cross-sell a wide variety of products to clients passively through its mobile app and website, reducing its cost of acquisition. As growth eventually decelerates, we also anticipate that SoFi will relax its aggressive marketing and reward spending programs, leading to a further margin expansion as well. As a result, we project that SoFi will reach an operating margin of 31% by 2031. 31%. Okay, let's go on. Risk and uncertainty. We expect a high Morningstar uncertainty rating to SoFi. SoFi's finances are in a strong position with over $3 billion in unrestricted cash and investment securities at the end of June. However, the nature of the company's revenue streams, its unprofitability, and the untested nature of the business model adds uncertainty. Finally, SoFi's final growing loan book exposes it to credit risks through its originate to distribute model, which mitigates this somehow from the loans eventually being sold on. There's definitely subject to a lot of different risks that they're seeing. Revenue, however, has become more diversified over time as it adds new products and services to its offering. So where is it? They say uncertainty is high for this to be pulled off. We did that one. No economic moat, fair value 1450. Now let's get into capital allocation. We assign a standard capital allocation rating to SoFi. SoFi has had a strong balance sheet and an appropriate shareholder return policy. We do look favorably upon the acquisition of Galileo, even when dilution from the purchase is accounted for. We see little financial risk from the firm. This is just going a little bit more in depth into the acquisition of Galileo, which we have seen accelerating growth in SoFi since they purchased it. The purchase price of $1.2 billion likely understates the acquisition's true cost, as SoFi paid for most of the purchase with convertible preferred shares that were issued with attractive terms. However, with annualized revenue in the first quarter of 2021 being $184 million, 130% year-over-year account growth, SoFi likely received a good deal from the firm, even with the dilution. On the other hand, the company will need to prove that the $1.1 billion acquisition of Technisys was a good use of shareholder capital. While this deal made strategic sense, given the ability to integrate its product sets with Galileo, the use of all share transaction at a depressed stock price raises eyebrows. SoFi will need Technisys to generate strong performance and cost savings to justify the expense. All in all, we give SoFi a standard capital allocation rating as we wait to see the results. Okay, going on, they're just going on about all the different takes that they've had throughout the history of SoFi, because they've been covering it for some time. This just shows historical data. We've seen all this. But what I'd like to show is the forecast. Obviously, these are projections. Doesn't mean that they're correct, so don't look too highly into them. But obviously, getting some other analysts' forecasts into the company is quite exciting. As you can see, 2021, 2022, and so far in 2023, this is what the numbers that they're expecting. This is the revenue growths that they're expecting throughout all of these these are the real revenue growths for these years. This is what they're expecting going forward. Continuous revenue slowdown. However, whenever we actually look at operating margins, this is what I think is so crazy. We've been negative forever, right? We are not a profitable company. In 2024, they believe that we'll hit profitability of just 0.6%, 2025, 10.7%. By 2031, you heard what they said. They believe that they'll have an operating margin of 31%, which is really, really freaking high. One thing that I did disagree with, however, that they highlighted here is that they believe that diluted shares outstanding, just 935 this year, and they're not counting anything going forward. Yeah, right. SoFi's not going to be buying back shares internally, and they still do have stock-based compensation. There will be an increase in diluted shares outstanding over time. So that should also be priced in to the overall price as well. But still. Let me go through. I'm pretty sure I didn't see anything else. Historically, this is where they've put their Morningstar ratings. Okay, before it used to be 3-4 stars, all the way up to totaling 5 stars across 2022, and just in the last 3 months, back down to 4 stars. However, at the top of this chart, actually, I think they show it off here. They still are representing it at 5 stars. I don't know how that works, or if they're just taking the average for the full 5 or for the full year, like the last 12 ones. But whenever comparing it to Discover or Ally or Synchrony, the ratings are much, much lower. You'd be really hard pressed to find any 5 stars across the board for any of these companies, where SoFi obviously has seen massive, massive price decreases back in 2022. Whenever the stock was like $4 to $6 per share is obviously a screaming buy looking at it back, historically. But that is the overall rating. Morningstar review for this company. They're obviously very, very bullish. They look at it from a quantitative perspective as well, and we can do that another day as well. But just from the way that I like to look at this company through, a more fundamental approach, they believe it's a $14.50 approach. And I actually don't think that they're looking at the company too unfairly. I think that even saying that they have no moat is quite fair, considering that I think the word moat is very, it's used very freely, okay? And if you're going to actually be very, very specific of, hey, can someone actually break in and steal customers, then you have a lot to actually, to show, rather than just saying, oh, you know what, they offer this certain amount of APY or they do this, because obviously those can actually be sort of competed on against, because look at Robinhood. They don't have a bank charter, and yet they can offer 4.9%. So if a customer is just looking at APY, they obviously don't have a reason to stay at SoFi at 4.5% versus 4.9%. That being said, however, I'm obviously a believer that this stock is very undervalued. It's been more undervalued previously in the eyes of Morningstar than it is today. But still, obviously a massive jump from $8.20 plus cents all the way up to $14.50. And the longer time goes on, obviously more customers, more revenues, more Galileo clients, these sorts of things, it's just going to push us closer to that stock price if it stays depressed the way it is. Now, I would like to move on to Nubank. Let me see if I can share my screen here. Nubank holdings raised to overweight as JP Morgan shows high principality. So the stock was up 8.74%. If you weren't able to buy under the $7 ranges, well, unlucky for you. Hopefully it drops back down if you didn't get back in, or if you weren't able to buy shares, but that was kind of the missed mark, okay? It was down $6.80. I said it was a screaming buy. Boom, up it goes. They pointed out that 1 in 4 Brazilians use Nu as their primary bank, representing a 27% principality, according to a proprietary client survey. In other words, the client's high principality implies market share gains in the years ahead, as the lender has between a 0 and 14% share in most of the products that it currently offers. Okay? Think about that. You have a 0 to 14% share in most markets that you're in, and yet you have the primary banking relationship with 27% of Brazilians, and that's only going up. like, still look at the growth at Nubank. It's still going sky high. Very, very exciting. In addition to principality, Nubank enjoys major cost advantages versus incumbents, meaning higher returns and better adaptability to regulatory noise in the long run. Okay? On a technical standpoint, the sell-side analyst took note of Nubank's recent correction, down 12.7% over the past month, calling it a good entry point for investors. Still, the stock is still up 97% year to date. A good entry point for investors. You're not going to get it as low as some of the people like myself were telling. Like, it's not even like I was quiet about it. There's public video of me saying, I was getting in this company at, $3 and plus cents, right? But still, I'm still buying at these prices. Anything in the $7 range is a screaming buy, in my opinion. This company is absolutely taking over Brazil, and Brazil itself is growing like crazy. Couldn't be happier with this investment. But ladies and gentlemen, that is the FinTech Frenzy live stream. Thank you all so much. If you guys enjoyed it, just hit that like button. Subscribe down below if you want to. Hit the bell if you want to see the next show. Okay? But aside from that, that's it. Love you guys. Bye for now.